I'm Owen Bigland. This is the Inside Edge video blog. Okay, it's near the end of 2019. We're heading into the holiday season. I'm getting ready to pack it in for the year pretty soon. As you guys know, I take off around mid-December and come back, in the first week in the new year. Usually head to Hawaii, Southern California. This year I'm also going to be in New York for about a week. So I thought let's, kind of lighten it up a little bit here. I wanted to do another blog here just on investing, and we'll pick up some of the heavier real estate stuff after the new year. But, reoccurring questions I get on my YouTube blog and emails from people and on Twitter, are about just staying the course in the buying and holding. And it's tough these days, and I know it is. You're bombarded with so much information, most of it negative. As I've said many times before here with the media does not like to do anything positive, very little. Maybe 1 out of every 10 articles might be on the positive side, whether that's the economy or trade or politics, the stock market, the real estate market, because positive articles don't sell newspapers and don't grab people's attentions. They need to hit you with the market is due for a 40% correction, crash just around the corner. Hedge fund manager says sell everything, the crash is just around the corner. Those are what grabs headlines, yet it leads people horribly astray. You need to ignore almost all that, and as I've pounded home many times, just buy and hold good quality assets, whether that's Vancouver real estate or good stocks, S&P 500 stocks, good Canadian dividend payers, or even some good European or international stocks. Just buy it and hold, stay the course. Now, in chapters 6 and 7 of my book, if you haven't read my book, and I may as well plug it, hey, Christmas is just around the corner, available on Amazon right now, $10 or $11 on Amazon. It's a top seller in the business category for a long time now. Read the nice reviews that I've had on the book. Thank you for everyone who continues to buy and review my book. Much appreciated, and I'm glad you found it useful and as a good door opener to getting started in both real estate and saving for your retirement. But, one of the things that took myself and Nick Rathel, who I co-wrote this book with in New York, one of the things that we spent the longest time on was chapter 6, 7 on the stock market and investing. And we had to come up with a way to kind of simplify it for people. And the analogy, if you've read my book, you'll know that I look at my stock portfolio like I would a 25-unit apartment building. And I think this will help people kind of understand what investing is all about, and to stay the course as well for the long term. So I look at my stock portfolio like I would, let's call it a 25-unit apartment building in Mount Pleasant. Every unit has a tenant in it, or every unit in this case has a stock in it. So on unit 102, I've got the Johnsons, Johnson & Johnson. In unit 304, I've got Mr. Bell Canada. In unit 506, I've got Stan Enbridge Pipelines. So every stock, I've got the Macdonalds, I've got the Apples, I've got the Proctors and the Gambles. So every unit, or every stock I hold, I look as a tenant in an apartment building I own. And I think if you look at it that way, it'll help you stay the course and ignore all the day-to-day price fluctuations that go on in the market, which confuses people and sidetracks people and gets them into making bad mistakes in trying to buy and sell stock when you don't need to. You just simply keep these. So I look at these companies just like I would a tenant in one of my condos. I've got a good tenant in there who every month is going to send me a rent check. And that rent check, most of it is going to go to pay down my mortgage, cover my property taxes, cover my maintenance fees. Depending on how long I've owned it, I might even need to supplement it a little bit. But after about 8 or 9 years, generally your tenant's rent check is covering everything, and a lot of times including your principal payment. But for my stock portfolio, my Johnson & Johnson every 3 months is going to send me a rent check, or what we call a dividend. And when you own 25 or 30 or 40 companies, all of them paying a quarterly dividend, not a week goes by, and they all pay them at different times throughout the year. So pretty much every week you're getting a rent check from one of your holdings. And that's a way you should look at your portfolio. It'll help you stay the course and not have to worry or not concentrate on the day-to-day market fluctuations. Because as I've said in my book, the price fluctuations on the stock day-to-day, let's say a company like Macdonald's, Oftentimes, those price fluctuations you see have almost little to nothing to do with the actual company, the underlying fundamentals of the company. In most cases, it's just large institutional traders moving in and out of stock. They might have to sell 10,000 shares of Macdonald's because they see a better opportunity in buying 5,000 shares of Visa. It's these continuous market rotations. But a lot of times people will see the price of Apple or the price of McDonald's go down $5 a share over 3 or 4 days and think there must be something wrong with the company. And there's not. There's nothing wrong with the company. On the other hand, you will have instances that directly correlate to the stock price. In other words, just recently, Steve Easterbrook, one of McDonald's best CEOs, a guy that I was a huge fan of, stepped down from McDonald's because of an affair that he had with an employee. The stock got hit pretty hard. Stock of McDonald's went down over the next couple of days about $6 or $7 a share. It's mostly recovered now. So in some cases, you do get these events that have a direct effect on the stock price. I look at sometimes these things as good buying opportunities. You know, Steve Easterbrook was an incredible CEO of McDonald's, but when it dropped $6 and it dropped another few more dollars the next day, I actually picked up a few extra shares on it. Even though he's going to be sorely missed as a CEO, and he brought that company in the last 3 years from about 80 some odd dollars a share, $90 a share, up to over 200. I made a ton of dough on McDonald's, and a lot of it has to do with that Steve Easterbrook. But those kind of things will have an effect on the stock. But for the most part, the ups and downs of a typical stock you hold has very little to do with the underlying fundamentals of the company. It's just continuous large volumes of trading amongst institutional investors. But you don't need to play that game. As I say, if you get these dips and you've got a little extra money, then top up on these good companies if it makes sense in a number of ways. If it fits into your portfolio, as long as you're not too heavily weighted in that stock or you need diversification in that area, then go ahead. Don't want to overcomplicate it too much. Again, my book goes into great detail on it. But what I also say in my book too, the vast majority of people in Canada or the United States that are saving for retirement, just buy the index. Just buy the S&P 500. One of my favorites is VIG, VIG, which is the Vanguard Dividend Appreciation Fund. It's a holding of about 400 of the best U.S. companies that not only pay a dividend, but raise that dividend like clockwork. It's the Dividend Aristocrat portfolio. You could buy that, tuck it away for 20 years, and it will serve you well. If you want to get a little more advanced down the road and increase your yield or your dividend payments, then for sure, you can start buying some individual stocks, but put the work in. The other thing I just want to tell you back onto dividends and how they work, because some people, their eyes glaze over. I'll give you an example here, Bell Canada. Bell Canada right now, at least a couple of months ago, it's gone up a bit here. Let's stay for argument's sake right now. It's yielding about 5%. That's the current dividend yield on Bell Canada, which is far better than what you're getting in fixed income. You know, people that are putting their money into term deposits and bonds and GICs, you got to educate yourself on this. You know, you're putting money into a GIC at 2%, you're losing money. A, it's not tax efficient, you're taxed at your full marginal rate, and inflation's running at 2.7%. So on fixed income right now, you're actually losing money. Bell Canada right now is paying about 5%. So if you bought $5,000 in Bell Canada shares today, you are going to get $250 every year, like clockwork, just off the dividends off Bell Canada. So the way I look at it is this, another way to kind of stay the course. I look at it, if I pull the trigger and buy $5,000 of Bell Canada, I look at it like I just bought myself 1 day of financial freedom. And what I mean by that is Bell Canada in quarterly installments is going to pay me $250 next year. Now, if I have my house paid off, no car payments and everything else when I retire, which I do, I can easily live off $250 a day. That'll buy me lots of food, keep me in steaks, keep me working out at the gym, keep me in protein powder, gas for my car, movies, concerts, whatever. So I look at it this way. You buy that $5,000 of Bell Canada today, you just bought yourself 1 day of financial freedom. You got 364 more to go. And for about 15 years in my early years investing, that's how I always looked at it. This was something that one of my friends in New York told me a way to look at it a little differently. When you buy those shares and it produces $250 or $300 in dividends, look at it as buying yourself one day of financial freedom. For some people, $250 might buy you, with your current lifestyle, might buy you 2 days of financial freedom. Now you're halfway there. Now you only need another 165 or whatever it is, 170 days to go. And you can now retire and just draw off those dividends. So it's another great way just to kind of focus on the long-term picture here. The other cool thing about buying companies like Bell Canada and Johnson & Johnson and Visa and Home Depot and Costco, not only do they pay you a dividend, but they will increase that dividend next year. They're making so much profit, so much cash flow, that they can reward their shareholders with a dividend boost. The dividend boost that I'm averaging right now on my portfolio of stocks is running just over 10%. So in other words, if Bell Canada pays you $1 a share in dividends every year, keep it simple, next year they might raise that to $1.07 or $1.08, or a 7% increase, which is about what Bell Canada has been averaging. So you think about it, you've got $100,000 you're generating off your portfolio in dividends. Next year that'll be 108 or 109 or 110. The year after that, you're earning dividends on top of dividends. It starts to compound and snowball. So when you look at it this way, the average dividend growth on my holdings, and we've got companies like Apple that have been boosting their dividends, double digit. Visa, I've been getting 15-18% dividend increases off Visa in some of these more growth oriented stocks. But just keep it simple. Let's say your dividend portfolio is growing at 7 or 8%. Well, if inflation's running at 3 and your dividend growth is running at 8 or 9, you're indexed to inflation by threefold. And that's what I talk about in my book. The real way to retire comfortably is to build a big enough portfolio, both in stocks and real estate, that the incomes that you're getting in the form of rent checks and dividend checks is enough to live on. You never have to sell any of the principal, any of the holdings. That's when life gets really sweet. Not only that, your rent checks from your tenants, they might not increase every year. I've done many blogs on that. You can only raise it 2.6. But eventually they move out and you bump the rent up $200 or $300 a month, or however long they've been in there, to get it back up to market rent. So your rent checks are going to be indexed to inflation, but your dividend payments are going to be indexed to inflation threefold if you buy the right companies. So that's how you will never run out of money in retirement. There's that old 4% rule, and I read articles all the time about how many people have got their biggest fear is running out of money because they're having to draw down their assets. That's when it can get dangerous, especially with longevity and people living longer and longer. They can get into their late 70s and they run out of money. The way to supercharge that or bulletproof it is to build a big enough portfolio that you can draw down the dividends, never have to touch the principal. And not only that, your dividend growth is indexed to inflation threefold. You're actually going to get more money every year. Or, instead of taking out that 4% rule, take out 1% or 2%. That will pretty much guarantee you'll also never run out of money as well. If you've got $1 million portfolio, then sure, draw down $5,000 a year or something plus your dividends. It all depends on your lifestyle and what you're going to need for retirement and what a day of financial freedom looks like for you. For some people, it might mean $300 a day. For other people, it might be $75 a day. It all depends on where you live, your lifestyle, and how you want to live in retirement. But I go through that in pretty great detail in my book. The other final thing I'll just talk about, I've been commenting to people on this for a while on my YouTube channel. I tell people that I am always pretty much 100% invested. I'm not one of those type of guys that holds large cash reserves for some big market correction. And if you're not following me on Twitter, I posted an article on Twitter from a hedge fund guy in New York. He's an anonymous blogger. He goes by the name of T3000, but I can tell you this guy is legit. This guy is a huge money manager in New York, and he writes an incredible investing blog. He did an in-depth study on why holding cash, large amounts of cash on the sidelines, is not doing you any good as an investor, and why you should always be pretty much fully invested. Read it. This was stuff that I already knew from some of my associates in New York. They've always preached that as well. It's funny. A lot of people seem to think that these hedge fund guys and these money managers will have you think that they're heavily weighted in cash to pounce on any corrections. Most of these guys, if you dig a little deeper, are almost always fully invested. However, they always have cash flows coming in like I do. When you get a big enough portfolio, you're always getting a fair bit coming in every month in the form of dividends. Plus, I'm always adding a little more to my portfolio from my working income. I'm always setting aside 10 or 15%. So every month I've got dry powder available to buy stocks to take advantage of any corrections. But I don't let that build up to 10% or 15 or 20% of my portfolio like some people claim they do. That is far too much. You're a market timer there. And you're seeing that now with some of these hedge fund guys. Some of these guys have been caught with their pants down big time in the last couple of years because they've been predicting this big crash in the S&P for years now. And they keep falling further and further behind. As this article I posted on my Twitter feed says, that they would need the market to drop 60 or 70% to make up them being on the sidelines in cash at 30% for the last couple of years. Just stay invested and reinvest or redeploy the dividend income you get. Don't get cute. Don't try and time markets, because I tell people too, there's always buying opportunities. Even right now with the S&P 500 at all-time highs, I still see stocks that I think are a good buy. There's always something on my shopping list that when I get the money, I pounce on it and buy it. So as I speak, it can change at any given time. I think Johnson & Johnson right now is a good pickup. It's off over $20 off its high. They've got the opiate lawsuits, the talcum powder lawsuits. Macdonald's is $20 or $25 off its high as well, now that they've got a new CEO. Probably a good buy for an investor, a guy who's going to buy the McDonald's shares, tuck it away for the next 15 or 20 years. There's always companies that I see that are priced right that I'm willing to pull the trigger on. Always. Just like there is in Vancouver real estate. There's always opportunities there in a buyer's market, seller's market, balance market. If you've got the investor mindset and the long-term horizon, buy it, hold it, keep it, and you're going to do fantastic. I'm Owen Bigland. Season's greetings to everybody. I'll see you in 2020. Thanks for watching. See you next year.